Namaskaram and welcome to Bharat Wealth, your trusted destination for sharp, data-driven insights into the Indian stock markets. This is your weekly wrap-up where we break down everything that moved the markets over the past 5 trading sessions, from benchmark index performance to sectorial trends, institutional inflows, macroeconomic triggers, and stock-specific actions. Did the bull market dominate the Wall Street, or did the bears take control? What drove the movement in Nifty and Sensex? Which sector outperformed and where did smart money rotate? In the next few minutes, we'll decode the key headlines, analyze FIs and DIS activity, track global cues, and highlight the stocks and themes you should keep on your radar for the coming week. So stay tuned till the end, because informed investors build wealth, and at Bharat Wealth we believe knowledge is your strongest asset. Let's get started. First, we'll discuss about Indian markets closing. Sensex closed at 81,287 points with 1.17% down. Nifty at 25,178 and Nifty IT down by 21%. Bank Nifty at 60,814, so the Nifty reality closed at 2.3% down. USD INR is at 90.85 paise. First, we'll discuss about the U.S. Supreme Court strikes down Trump's tariff. So, in a landmark ruling, the United States Supreme Court struck down President Donald Trump's sweeping Liberation Day tariffs on Friday, February 21st, sending shockwaves across global markets over the weekend. The ruling was a major relief for emerging markets investors who had been bracing for high export duties. Indian equity futures surged instantly, with GIFT Nifty jumping over 320 points on the news. White House officials responded by announcing a temporary 10% tariff under Section 122 of the Trade Act of 1974, effective from February 24th to last 150 days. As crucial for India, officials clarified that the effective tariff rate on Indian goods would drop from 18% to just 10%, reducing pressure on key export sectors. Analysts at Elara Capital estimated India's implied tariff rate at only 9.1%, offering significant relief to textile, pharma, and IT exports. Markets opened the week on a highly optimistic note, with the Wall Street poised for a strong rally heading into Monday. Next, we'll discuss about Sensex gains 0.58%. Nifty holds about 25,700. Market opens week in green. Indian benchmark indices opened the week on a bullish note on Monday, February 23rd. As investor sentiment benefited from the U.S. Supreme Court's tariff ruling over the weekend. The BSE Sensex advanced around 0.58%, while the Nifty 50 closed comfortably above the critical 25,700 level, reflecting widespread buying. Banking stocks provided strong leadership as the Bank Nifty outperformed, gaining ground for its third consecutive weekly advance. Domestic institutional investors continued their sportive role with significant net purchases, counterbalancing residual caution from foreign fund managers as well. Broader market indices also participated in the rally, with the Nifty mid-cap and small-cap indices edging higher. Technically, the Nifties hold about the 200-day exponential moving average, signaling a constructive short-term trend. Analysts flagged the 25,850 to 25,900 zone as the key resistance band that needed to be cleared for the uptrend to extend towards 26,100. Moving on to the next story. Now, Trump's new 15% temporary tariff sparked market crash. Tuesday, February 24 saw Indian markets plunge sharply as fresh tariffs fears rattled the Dalal sheet in one of the worst single-day sessions of the month. President Trump escalated the trade-off by announcing a new temporary 15% global tariff, warning countries against backing away from recently negotiated trade deals following the Supreme Court ruling. The BSE Sensex crashed 1,068 points to close at 82,225, while the Nifty 50 shed 288 points to settle at 25,424 points. HDFC Bank, L&T and IT sectors heavyweights were among the biggest drags as the sentiment soared abruptly. February 24th also happened to be the monthly derivatives expiry session, adding to intraday volatility and sharp swings in both directions. Analysts noted the Nifty 50 slipped below its key exponential moving averages, while momentum indicators flashing mid-weakness. The session underscored how sensitive Indian markets remain to every word from the White House on trade policy. Next, move on to the next story. The Indian IT sector was the dominant negative story of the month, with the Nifty IT index tumbling a staggering 21% through February, one of the steepest sectors crash in recent memory. The primary trigger was the launch of advanced AI capabilities and coding tools by Anthropic, the American AI startup, which raised profound fears about automation displacing traditional software services revenue from Indian IT firms. Major IT companies including TCS, Infosys, HCL Tech, and Wipro saw significant single-day losses in multiple sessions, with several stock corrections 18 to 26% from their recent peaks. The panic reflected concerns that AI-native tools like Cloud Code could reduce the demand for outsourced development work from Indian vendors. However, not all analysts were bearish. Some, including Geojit's VK's Vijay Kumar, argued that Anthropic's partnership model with IT firms would create new collaboration opportunities rather than cannibalizing business. By weeks and selective low-level buying emerged in quality IT names, suggesting the worst of the sell-off may have been priced in. Next, going on to the next story. After Tuesday's brutal sell-off, Indian markets tagged a sharp recovery on Wednesday, February 25th, with IT stocks at the forefront of the turnaround. The BSE Sensex jumped as much as 522 points in early trade, eventually closing up solidly. With the Nifty climbed back above the 25,550 levels, Tech Mahindra led the recovery with gain of over 2.7%, while HCL Technologies, TCS, Infosys all advanced between 2.3 to 2.7%, reversing a portion of their recent steep losses. The recovery was supported by positive global cues, as all three major Wall Street indices have closed in the green the previous night. Asian markets also traded higher, with Japan's Nikkei gaining over 1.4% and South Korea's Kospi surging 2.37%. Analysts noted that FIs had begun turning net buyers of Indian equities in February after a prolonged spell of selling, providing fundamental support to the recovery. A session offered some relief in investors who had been rattled by the AI-driven sell-off earlier in the week. Next, go to the next story. Now we discuss about macro developments. One of the most eagerly waiting macro event of the week was the release of India's Q3 GDP growth data. scheduled for post-market hours on February 27th. Economists and market participants were closely watching the figures for signs of continued resilience in Asia's third largest economy. India's Q4 GDP was expected to ease from 8.2% growth recorded in the prior quarter, which had been the strongest expansion since early 2024. The domestic economy had benefited from strong manufacturing activity, a robust monsoon supporting rural demand, and continued government capital expenditure, providing a solid foundation for growth. However, urban consumption showed selective fatigue, and job creation remains a concern for sustaining long-term momentum. Analysts suggested that a better than expected GDP print could offer some support to equity markets in subsequent sessions. The data release came at a sensitive time, with investors navigating a complex mix of global trade tensions and domestic earnings season winds down. Moving on to the next story. Now we talk about global and geopolitical tensions. US-Iran nuclear talks stall. Geopolitical uncertainty emanating from stalled US-Iran nuclear negotiations in Geneva became a persistent headwind for Indian markets through the second half of the week. The lack of progress in the talks intensified concerns about potential escalations of Middle East tensions, which could disrupt global crude oil supplies and reignite inflationary pressures. For India, a net oil importer, any spike in crude prices carries direct implications for the current account deficit, the rupee, and ultimately corporate margins. Safe haven flows towards gold and US Treasuries increased risk appetite globally that deteriorated. On Friday, market analysts at Geodat cited rising geopolitical risks as the key factor driving the cautious investor mood, alongside persistent FII selling. The uncertainty also contributed to the broader risk of tone that characterized the closing sessions of February. Traders were advised to monitor developments from Geneva closely, as any breakthroughs or breakdown could have an outsized impact on India's financial markets in the near term. Next, moving on to FIs and DIs inflows. Now we talk about FIs and DIs flows. In the significant shift, FIs turned net buyers of Indian equities in February 2026, ending a prolonged cycle of selling that had pressured Dalal Street through much of the previous year. On the Thursday, Friday, February 26, FIs were net purchases of 3,483 crores, providing a meaningful boost to large cap stocks in financial services, capital goods, and pharmaceuticals. Analysts noted this reversal had fundamental backing: India's strong GDP growth, recovering corporate earnings, and attractive valuations relative to other emerging markets. However, FIS buying was not sustained uniformly. By Friday, foreign funds had gained turn net sellers to the tune of 3,466 crores as risk aversion resurfaced. Domestic institutional investors continued their unwavering role as the backbone of market stability, absorbing selling pressure through steady FI inflows and institutional purchasing. Monthly SRP contributions of approximately 30,000 crores remaining a structured positive for Indian equities. The involving FI-DIA dynamic is being watched closely as a key indicator of market direction in the coming weeks. The board of Tata Sons convened at the group's historic Bombay House headquarters and was set to consider approving a third consecutive term of Natarajan Chandrasekharan as chairman. A significant corporate governance movement for India's most storied conglomerate. Chandrasekharan, who took charge of Tata Sons in 2017, has been widely credited for the refocusing the group's sprawling portfolio, executing major strategic transactions and improving overall performance across Tata companies. The reappointment, however, was being deferred pending regulatory and procedural considerations, with analysts noting the deferral would have several important implications for group strategy and succession planning. Tata Group companies including TCS, Tata Motors, Titan, Tata Steel and Tata Power collectively carry a significant weight in Nifty and Sensex indices, making leadership stability at Tata Sons a matter of wider market interest. Corporate governance watchers were tracking the development closely, given the Tata Group's model, ownership structure and its influence on the broader Indian business community. A smooth renewal of Chandrasekharan's mandate was expected to provide continuity and investor confidence across the group's diverse businesses. That's all about it. That's our weekly market wrap-up. Thanks for watching. Like, share and subscribe to Market Well and comment below what you're thinking and forecasting the next week from now. So comment below and we'll see how the market goes next week. Thank you very much.
This video is for educational purposes only. Investments are subject to market risks. Read all the related documents carefully before doing your investments.